Okay, chapter 2, and we are chatting with Bruce Kovner, the world trader. Quick mention to Staker app. Earn while you sleep. Earn while you sleep. And Staker app is a great way to monitor your hex contracts. It's a beautiful designed app, and let's have a quick delve into the website. And you can access or download this website through my channel banner headline. This should be a link. Earn your future 10% APY. I'm not too sure if this is up to date. Already paid this year, but on the Staker app, in the app, it will tell you the monthly payouts to the stakers in the staking community. Active community, I believe it's 32,000 users. Average stake is approaching 6 years now. Access decentralized finance and discover great opportunities. Truly revolutionary, the Hex contract, and Staker app is a great complement. So there you have it. Again, link on my channel banner. But let's talk to Bruce in his interview with Jack D. Schrager, the world trader. Today, Bruce Kovner may well be the world's largest trader in the interbank currency and futures market. In 1987 alone, he scored profits in excess of $300 million. $300 million. Wow. For himself and the fortunate investors in his fund. During the past 10 years, Kovner has realized the remarkable 87% averaged annual compounded return. 87%. Wow. $2,000 invested with Kovner in early 1978 would have been worth over $1 million $10 later. And this is $1 million in 1987 currency, right? 34 years ago. How much was a new car back then? Not 38,000 like it is today. I think that is the average US consumer pays for a new car, $38,000. I'm guessing it's less than 10 back then. Despite this incredible track record and huge trading size, Kovner has managed to keep a surprisingly low profile. He has assiduously pursued his privacy by steadfastly refusing all interview requests. You might be wondering why I consented to this interview, quotation marks. He said, as a matter of fact, I was, but I did not want to raise the question. I had assumed that his agreement reflected a vote of confidence and trust. 7 years earlier, our paths had crossed briefly when we both worked at Commodities Corporation. He as one of the firm's principal traders. I was an analyst. Kovner continued, it seems like I can't avoid some publicity, and the stories are usually distorted and fanciful. I thought that this interview would help establish at least one accurate record. Kovner hardly fits the intuitive image of a trader who typically holds positions with a total face value measured in billions of dollars. With his incisive intellect and easygoing manner, he reminds one more of a professor than a giant-scale trader in the highly leveraged currency and futures markets. Indeed, Kovner started out as an academic. After graduating from Harvard, Kovner taught political science courses at Harvard and the University of Pennsylvania. Although he liked teaching, he was not infused with the academic life. I didn't enjoy the process of always confronting a blank page in the morning and thinking of something brilliant to write. In the early 1970s, Kovner managed a number of political campaigns with the idea of eventually running for office himself. He abandoned politics because he didn't have the financial resources or the desire to work his way up the political ladder from committee jobs. During this time, he also worked as a consultant for various state and federal agencies. Still searching for a career direction, Kovner shifted his attention to the financial markets in the mid-1970s. He believed that his economics and political science education provided the right background, and he found the idea of analyzing the world to make trading judgments tremendously appealing. For about a year, Kovner immersed himself in studying markets and related economic theory. He read everything he could get his hands on. He did his research. One subject he studied intensively was interest rate theory. I fell in love with the yield curve. The yield curve is the relationship between the yield on government securities and the time to maturity. For example, if each successively longer term maturity provided a higher yield than a shorter term maturity, for example, 5-year T notes at a higher yield than 1-year T bills, the yield curve would reflect a continually rising slope on a graph. Kovner's study of the interest rate markets coincided with the initial years of trading in interest rate futures. At that time, the interest rate futures market was relatively unsophisticated, and price distortions, which would be quickly eradicated by arbitrators today, persisted over time. As Kovner explained, the market hadn't become important enough for Citibank or Solomon Brothers, but it was important enough for me. One of the primary anomalies Kovner discovered was related to the price spread, or the difference between different futures contracts. Futures are traded for specific months. For example, March, June, September, and December. Given the prevailing phase of the business cycle, interest rate theory predicted that the nearby contract, for example, March, should trade at a higher price or lower yield than the next contract, for example, June. That makes sense, right? Although the nearest two contracts did indeed tend to reflect this relationship, Kovner found that the price difference between more forward contracts often started trading at near zero levels. His first trade involved buying a forward interest rate contract and selling a more forward contract, in the expectation that as the purchase contract became the nearby contract with the passage of time, the price spread between the two contracts would widen. That first trade worked just according to textbook theory, and Kovner was hooked as a trader. His second trade also involved an intra-market spread, the purchase of one contract against the sale of another contract in the same market. In this case, he bought the nearby coppers contract and sold a more forward contract, in the expectation that supply tightness would cause the nearby copper contract to gain relative to the forward position. Although his trade eventually proved right, he was too early and lost money on the trade. At the end of these two trades, Kovner was still ahead, with his original $3,000 stake having grown to about $4,000. My third trade is what really put me in the business. In early 1977, an apparent shortage was developing in the soybean market. It was a demand-driven market. Every week the crush was higher than expected, and nobody believed the figures. The crush is the amount of soybeans processed for use as soybean meal and soybean oil. I was watching the July-November spread, the price difference between the old crop July contract and new crop November contract. Since it looked like we were going to run out of soybeans, I thought that the old crop July contract would expand its premium to the new crop November contract. This spread had been trading in a narrow consolidation near 60 cents premium in July. I figured I could easily stop myself out just below the consolidation at around 45 cents premium. At the time, I didn't realize how volatile the spread could be. I put on one spread that is bought July soybeans and simultaneously sold November soybeans near 60 cents and it widened to 70 cents. Then I put on another spread. I kept on pyramiding. How big of a position did you build up? Eventually, I built up to a position of about 15 contracts, but not before I had to switch brokerage firms. When I started out, I was trading at a small brokerage house. The head of the company, who was an old floor trader, went over the trades every day and spotted what I was doing. By that time, I had built up my position up to about 10 or 15 contracts. The margin on a single outright contract was $2,000, while the spread margin was only about $400. He told me the spread position you have on trade is like an outright long position. I'm going to raise your margin from $400 to $2,000 per contract. Spread margins are lower than outright margins, reflecting the assumption that a net long or short position will be considerably more volatile than a spread position. Reason: in a spread, the long contract portion of the position is likely to at least partially offset price movement in the short contract position. In a shortage situation, however, an intercrop spread such as long July, short November soybeans can prove to be nearly as volatile as a net long or short position. He was obviously quite concerned with the risk in your position. Yep, he was concerned that I only put up $400 on margin per spread on a spread which behaved like a net long position. Actually, he wasn't that far off. He was right, but I was furious, so I moved my account to another brokerage firm, which will remain nameless for reasons that will soon become clear. You were furious because you felt he was being unfair, or, well, I'm not too sure. I thought he was being unfair, but I certainly knew he was an obstacle to my objective. I moved my account to a major brokerage house and got a broker who was not very competent. The market kept moving up, and I kept adding to my position. I had put on my first spread on February 25th. By April 12th, my account was up to $35,000. Were you just adding to your position, or as the market went up, or did you have some plan? I had a plan. I would wait until the market moved up to a certain level and then retrace by a specific amount before adding another unit. So my pyramiding did not turn out to be the problem. The market had entered a string of limit up moves. On April 13th, the market hit a new record high. The commotion was tremendous. My broker called me at home and said, "Soybeans are going to the moon. Looks like July is going limit up and November is sure to follow. You are a fool to stay short the November contracts. Let me lift your November shorts for you. And when the market goes limit up for the next few days, you will make more money." I agreed and recovered my November short position. All of it, he laughs loudly. Was this a spur of the moment decision? It was a moment of insanity. 15 minutes later, my broker calls me back and he sounded frantic. "I don't know how to tell you this, but the market is limit down. I don't know if I can get you out." I went into shock. I yelled at him to get me out. The market moved off limit down by a little bit, and I got out. Did you end up getting out at limit down? I got out between limit down and slightly above limit down. I can tell you the dimensions of the loss. At the moment I covered my short November position, leaving myself net long July, I was up about $45,000. By the end of the day, I had $22,000 in my account. I went into emotional shock. I could not believe how stupid I had been. How badly I failed to understand the market. In spite of having studied the market for years, I was sick to my stomach. And I didn't eat for days. I thought I had blown my career as a trader. but you still had $22,000 compared to your original stake of only $3,000. Keeping things in perspective, you were still in pretty good shape. Absolutely, I was in good shape, but was it the stupidity of the mistake, or was it the amount, or was it the money that you had given back that caused such emotional pain? No, it wasn't the money at all. I think it was the realization that there really was fire there. Until then, I had ridden $3,000 to $45,000 without a moment of pain. On the way up, did you think this is easy? It was easy. Did you give any thought to the possibility that the market streak could eventually go the other way? Nope. But clearly, my decision to lift the short side of my spread position in the middle of a panic showed a complete disregard for risk. I think what bothered me so much was the realization that I had lost the process of rationality that I thought I had. At that moment, I realized that the markets were truly capable of taking money away every bit as fast as they give it to you. That made a very strong impression on me. Actually, I was very lucky to get out with $22,000. I assume that your quick action that day probably averted a complete disaster. Absolutely. After that day, the market went straight down as fast as it had gone up. Perhaps if I hadn't made any stupid mistake, I might have made a mistake of riding the market down. What eventually happened to the spread? The spread collapsed. Eventually, it went below the level that I had first begun buying it at. Since you liquidated your position on the day the market and the spread topped, you would have given back a portion of the profits, even if it wasn't for that disastrous decision that you forced you out of the market. That may be true, but for me, that was my going bust trade. It was the closest I ever came to going bust, and psychologically, it felt as if I had. Was that your most painful trade? Yep, far and away. Even though you actually ended up making a substantial amount of money on that trade. I multiplied my money by nearly sixfold on that trade. I was, of course, insanely leveraged. I didn't understand how risky my position was. Was getting out of your entire position immediately after your broker called to tell you the market was limit down a matter of panic? Or do you think you had some instinctive common sense about controlling risk? I'm not sure. At that moment, I was confronted with the realization that I had blown a great deal of what I thought I knew about discipline. To this day, when something happens to disturb my emotional equilibrium and my sense of what the world is like, I'll close out all positions related to that event. Do you have a recent example? October 19th, 1987, the week of the stock market crash. I closed out all my positions on October 19 and 20 because I felt there was something happening in the world that I didn't understand. The first rule of trading, there are probably many first rules, is don't get caught in a situation in which you can lose a great deal of money for reasons you don't understand. Let's get back to the period after your soybean trade. When did you start trading again? About a month later. After a few months, I had my account back to about $40,000. Around that time, I answered an ad for a trading assistant position at Commodities Corporation. I was interviewed by Michael Marcus in his usual idiosyncratic manner. He had me return to Commodities Corporation several weeks later. Well, he said, I have some good news and some bad news. The bad news is that we are not hiring you as a trading assistant. The good news is that we are hiring you as a trader. How much did Commodities Corporation give you to trade? $35,000. Were you trading your own money as well at the same time? Yes, and that is something I'm very glad about. Commodities Corporation had a policy that allowed you to trade your personal account as well as the company account. And Michael and I were very aggressive traders. Were you influenced by Michael? Oh, yeah, very much. Michael taught me one thing that was incredibly important. That's a great lead in. What is the punchline? He taught me that you could make $1 million. He showed me that if you applied yourself, great things could happen. It is very easy to miss the point that you really can do it. He showed me that if you take a position and use discipline, you can actually make it. It sounds like he gave you confidence. Right. You also taught me one other thing that is absolutely critical. You have to be willing to make mistakes regularly. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. You are one of the most successful traders in the world. There are only a small number of traders of your caliber. What makes you different from the average guy? I'm not sure one can really define why some traders make it while others do not. For myself, I can think of two important elements. First, I have the ability to imagine configurations of the world different from today and really believe it can happen. I can imagine that soybean prices can double or the dollar can fall to 100 yen. Second, I stay rational and disciplined under pressure. Can trading skills be taught? Only to a limited extent. Over the years, I have tried to train perhaps 30 people, and only 4 or 5 of those have turned out to be good traders. What happened to the other 25? They are out of the business, and they had nothing to do with intelligence. When you compare the trainees that make it to the majority who do not, did you find any distinguishing traits? They're strong, independent, and contrary in the extreme. They are able to take positions others are unwilling to take. They are disciplined enough to take the right size positions. A greedy trader always blows out. I know some really inspired traders who never managed to keep the money they made. One trader at Commodities Corporation, I don't want to mention his name, always struck me as a brilliant trader. The ideas he came up with were wonderful. The markets he picked were often the right markets. Intellectually, he knew markets much better than I did, yet I was keeping money and he was not. So where was he going wrong? Position size. He traded much too big. For every one contract I traded, he traded 10. He would double his money on 2 different occasions each year, but still end up flat. Do you always use fundamental analysis in forming your trading decisions? I almost always trade on market view. I don't trade simply on technical information. I use technical analysis a great deal, and it is terrific, but I can't hold a position unless I understand why the market should move. Is that to say that virtually every position you take has a fundamental reason behind it? Yeah, I think that's a fair statement, but I would add that technical analysis can often clarify the fundamental picture. I will give you a good example. During the past 6 months, I had some good arguments for the Canadian dollar going down, and good arguments for the Canadian dollar going up. It was unclear to me which interpretation was correct. If you had to put a gun to my head and force me to choose a market direction, I probably would have said down. Then the US-Canadian Trade Pact was announced, which changed the entire picture. In fact, the market had broken out on the upside a few days earlier, as the negotiations were finishing up. At that instant, I felt completely comfortable saying that one of the major pieces in the valuation of the Canadian dollar had just changed, and the market had already voted. Prior to the agreement, I felt the Canadian dollar was at the top of a hill, and I wasn't sure whether it was going to roll backwards or forwards. When the market moved, I was prepared to go with that movement because we had a conjunction of two important elements: a major change in fundamentals. Although I wasn't smart enough to know in which direction it would impact the market, and a technical price breakout on the upside. What do you mean you weren't smart enough to know in which direction the trade pack announcement would move the market? Since US Canadian trade is so much a larger component of Canadian trade than it is of US trade, wouldn't it have been logical to assume that the trade pact would be bullish for the Canadian dollar? It didn't have to happen that way. I can just easily have argued that the trade pact was negative for the Canadian dollar because the elimination of the trade barrier would allow imports from the US to submerge Canadian interests. There are still some analysts who adhere to that argument. My point is that there are well-informed traders who know much more than I do. I simply put things together. They knew which way to go, and they voted in the marketplace by buying Canadian dollars. Is the generalization of that example that when an important fundamental development occurs, the initial direction of the market move is often a good tip-off of the longer-term trend? Yeah, exactly. The market usually leads because there are people who know more than you do. For example, the Soviet Union is a very good trader. Good trader in which markets? In currencies and grains to some degree. Because how does one know what the Soviets are doing? Because the Soviets act through commercial banks and dealers, and you hear about it. It seems rather contradictory to me that the country that is so poor in running its own economy should be a good trader. Yeah, but if you ask people in the business, you will find out that they are. Why or how? It is a joke, but perhaps they do read some of our mail. The Soviets and other governments occasionally have advanced information. Why shouldn't they? They have the best developed intelligence service in the world. It is a well-known fact in the intelligence community that the Soviets and others are capable of eavesdropping on commercial communication. That is why large commodity trading firms sometimes use scramblers when they are making very sensitive calls. My point is that there are thousands of different, difficult to understand mechanisms that lead the market, which come into play before the news reaches some poor trader sitting at his desk. But the one thing that does hit the market is a huge sale or purchase. Isn't that the basic rationalization for technical analysis? Technical analysis, I think, has a great deal that is right and a great deal that is mumbo jumbo. That's an interesting statement. What's right and what's black magic? There's a great deal of hype attached to technical analysis by some technicians who claim that it predicts the future. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. But of course, that would be sheer folly. If you're a responsible participant in the market, You always want to know where the market is, whether it is hot and excitable or cold and stagnant. You want to know everything you can about the market to give you an edge. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. It is very important for me to study the details of price action to see if I can observe something about how everybody is voting. Studying the charts is absolutely crucial and alerts me to existing in disequilibria and potential changes. Do you sometimes put on a trade before you look at a chart and say, I've seen this pattern before? And it is often a forerunner of market advance. That is, even though you may not have any fundamental reasons for it. I will do that sometimes. I would only add that as a trader who has seen a great deal and been in a lot of markets, there is nothing disconcerting to me about a price move out of a trading range that nobody understands. Does that imply you usually go with breakouts? Sure. But the markets are often prone to false breakouts. There has to be more to it than that. Tight congestions in which a breakout occurs for reasons that nobody understands are usually good risk-reward trades. How about breakouts that occur because there is a story in the Wall Street Journal that day? That would be much less relevant. The Heisenberg principle in physics provides an analogy for the markets. If something is closely observed, the odds are it is going to be altered in the process. If corn is in a tight consolidation and then breaks out the day the Wall Street Journal carries a story about a potential shortage of corn, the odds of the price move being sustained are much smaller. If everyone believes there is no reason for corn to break out and it suddenly does, the chances that there is an important underlying cause are much greater. It sounds like what you are saying, that the less explanation there is for a price move occurring, the better it looks. Well, I do think that the more a price pattern is observed by speculators, the more prone you are to have false signals. The more a market is the product of non-speculative activity, the greater the significance of technical breakouts. Very interesting stuff. I think I'm going to cut this into two parts, like I did with Michael Marcus, and I'll come back to talking to Bruce through Jack D. Swagger. I think it's been really good so far, with some real gems he's been dropping. So come back for part 2.